Good evening and welcome to Financial Freedom Desk. I'm John Egg, and tonight we are pulling back the curtain on something that has been building quietly inside the silver market, something that a frontline dealer has now openly described as a big problem. And when the people who actually handle physical silver every single day start talking about structural issues in the market, that is not noise. That is signal. And on this channel, we follow the signal. Before we go any further, if you are new here, hit that subscribe button right now and tap the bell. This is the channel that connects the dots between what is happening in commodity markets and what it means for your financial future. No hype, no agenda, just honest, deep analysis. And if you have been here before, hit that like button because tonight's breakdown deserves to be seen by as many people as possible. Tonight, we are going 360 degrees on this story. We are going to talk about what the dealer actually revealed, why it matters structurally, what it tells us about the gap between the paper silver market and the physical silver market, and what every investor, whether you own silver already or are considering it, needs to understand about the environment we are operating in right now. Let's get into it. Let me start by establishing something important, because context matters enormously when evaluating any market commentary. When a television analyst or a Wall Street economist talks about silver, they are typically talking about silver as a number. On a screen, they are looking at futures contracts, at options pricing, at technical chart patterns. Their relationship with silver is fundamentally abstract. It is a financial instrument to them, not a physical object. A silver dealer operates in an entirely different reality. A dealer is the person whose phone rings when someone wants to buy 10 ounces or 10,000 ounces of physical silver. A dealer is the person who has to source that metal, price it, store it, insure it, and deliver it. A dealer feels the market not through screens, but through inventory levels, through customer behavior, through the conversations happening at the street level of the physical precious metals trade. When a dealer says there is a big problem, they are not reading a report. They are describing what they are personally experiencing in real time. And that distinction matters enormously for understanding the significance of what has been revealed, because the problem being described is not theoretical. It is not a model output or a projection. It is a ground-level operational reality that is playing out in the physical silver market right now. And the gap between what that ground-level reality looks like and what the paper price of silver suggests is precisely where the most important story in this market lives. So what exactly is the problem? Let's break it down layer by layer. Let me start by establishing something important, because context matters enormously when evaluating any market commentary. When a television analyst or a Wall Street economist talks about silver, they are typically talking about silver as a number. On a screen, they are looking at futures contracts, at options pricing, at technical chart patterns. Their relationship with silver is fundamentally abstract. It is a financial instrument to them, not a physical object. A silver dealer operates in an entirely different reality. A dealer is the person whose phone rings when someone wants to buy 10 ounces or 10,000 ounces of physical silver. A dealer is the person who has to source that metal, price it, store it, insure it, and deliver it. A dealer feels the market not through screens, but through inventory levels, through customer behavior, through the conversations happening at the street level of the physical precious metals trade. When a dealer says there is a big problem, they are not reading a report. They are describing what they are personally experiencing in real time. And that distinction matters enormously for understanding the significance of what has been revealed, because the problem being described is not theoretical. It is not a model output or a projection. It is a ground level operational reality that is playing out in the physical silver market right now. And the gap between what that ground level reality looks like and what the paper price of silver suggests is precisely where the most important story in this market lives. So what exactly is the problem? Let's break it down layer by layer. The core issue that dealers are flagging can be described in one phrase: a deepening disconnect between paper silver and physical silver. And I want to make sure you understand exactly what that means, because it is the foundation of everything else we are going to discuss tonight. Paper silver refers to silver that is traded on futures exchanges like COMEX, in silver ETFs, in derivatives contracts, and financial instruments of various kinds. When you see the silver spot price quoted on any financial platform, that price is primarily derived from paper trading. It reflects the balance of buyers and sellers in the futures market, not necessarily the balance of people trying to actually hold physical metal in their hands. Physical silver is exactly what it sounds like. Actual silver bars, coins, and rounds that you can touch, hold, store, and deliver. The physical market has its own dynamics, its own supply chain, its own premiums over spot, its own inventory levels, and its own demand pressures that do not always match what is happening in the paper market. Under normal, healthy market conditions, the paper price and the physical market stay relatively aligned. The premium you pay over spot to buy a physical silver coin or bar is small, typically $1 or $2 per ounce in a well-functioning market. That small premium reflects the legitimate costs of manufacturing, shipping, and handling the physical metal. It is not a signal of stress, but what dealers are now reporting is that this relationship has been breaking down. Premiums on physical silver have been significantly elevated compared to historical norms. Inventory availability at the dealer level has been inconsistent. Wait times for certain products have stretched in ways that simply do not happen in a healthy, well-supplied market. And the volume of customers trying to buy physical silver has been outpacing the ability of the supply chain to keep up in a smooth and predictable way. Now, here is where it gets genuinely interesting, and this is the part that most financial coverage completely misses. The physical silver supply chain is not a simple two-step process. It is not just silver coming out of the ground and landing in a coin shop. It is a complex, multi-layered system involving mining companies, refineries, mints, wholesale distributors, and retail dealers. And stress at any point in that chain creates ripple effects that eventually show up as the problems dealers are describing. The mining side of the equation is the first layer of the problem. Silver mining production has not kept pace with the growth in demand from industrial users. Remember, silver is not just a monetary metal. It is a critical industrial input for solar panels, electric vehicles, semiconductors, and medical devices. Industrial demand has been growing steadily, while new mining supply has been relatively flat. When you have growing demand meeting flat supply, the physical market tightens. And a tight physical market means dealers have less inventory to work with and must pay more to source the metal they need. The refinery and mint layer adds another dimension. The capacity of refineries and government mints to process raw silver into the coins, bars, and rounds that retail investors want is finite. When demand spikes, as it has during periods of financial uncertainty, inflation concern, or geopolitical stress, the manufacturing capacity simply cannot scale overnight. Lead times extend, certain products go on allocation, dealers find themselves telling customers that the specific product they want is unavailable for weeks or months. And then there is the wholesale distribution layer, where the problem the dealer is describing becomes most visible. Wholesale silver distributors who supply dealers have been experiencing their own inventory pressures. This brings us to what I think is the most important analytical question in the entire silver market right now. If the physical supply situation is genuinely stressed, if dealers are struggling to source metal, if premiums are elevated, if wait times are extending, then why isn't the paper price of silver reflecting that stress more dramatically? This is the question that separates investors who understand the silver market from those who are just watching a number on a screen. And the answer to it is both fascinating and, depending on your perspective, deeply troubling. The paper silver market, the futures exchange where the spot price is primarily determined, is dominated by large financial institutions, algorithmic trading systems, and speculative traders whose positions dwarf the physical market in terms of notional value. The paper silver market trades an amount of silver every single day that is many times larger than the total amount of physical silver produced globally in an entire year. Think about that for a moment. Paper silver trades at a volume that has almost no relationship to the actual physical reality of silver supply and demand. In this kind of market structure, short-term price discovery is heavily influenced by financial positioning and macroeconomic factors, interest rate expectations, dollar strength, risk appetite in broader markets, rather than by the physical supply and demand dynamics that a dealer experiences at the ground level. This means the paper price can remain disconnected from physical reality for extended periods. Dealers can be screaming about supply problems while the spot price sits in a range that suggests everything is fine. But here is the critical historical pattern that makes this situation worth watching very carefully. These disconnections between paper and physical markets do not last forever. Eventually, the physical reality asserts itself. So let me give you the specific things that an informed silver investor should be monitoring right now, because this is actionable intelligence, not just analysis. The first thing to watch is physical premiums at the retail level. Check what silver eagles, silver maples, or 1-ounce silver rounds are actually selling for at reputable dealers relative to the spot price. If the premium over spot is consistently above $5 or $6 per ounce on standard products, that is a signal that physical supply is under stress, regardless of what the paper price is doing. If that premium is shrinking toward historical norms, it signals the supply chain is easing. This is a real-time indicator that anyone can check without a Bloomberg terminal. The second thing to watch is product availability and wait times. If major dealers are consistently showing popular products as out of stock or on back order with extended wait times, that is the market telling you something about physical supply that the spot price is not telling you. Conversely, if inventory is abundant and immediately available, that is a sign of relative physical ease. The third metric is COMEX registered silver inventory, which we have discussed in previous breakdowns on this channel. The rate at which registered silver, the metal actually available for futures delivery, is draining from exchange vaults, is one of the most important physical signals in the entire market. Watch that number. And the fourth thing to watch is the behavior of large dealers themselves. When established, reputable precious metals dealers start publicly discussing supply problems, as is happening right now. That is not marketing. That is a warning. These are businesses whose survival depends on having product to sell. When they say supply is a problem, believe them. They have no financial incentive to exaggerate that particular concern. Let me bring everything together because I want you to leave tonight with something real and concrete rather than just a collection of interesting facts about the silver market. What a frontline silver dealer is revealing right now is not a temporary glitch or a seasonal inventory issue. It is a structural signal, a visible symptom of a deeper misalignment between the financial system's representation of silver and the physical reality of silver supply and demand. The paper price says one thing, the physical market is whispering something different. And the people who are paying attention to that whisper, the dealers, the sophisticated physical buyers, the analysts who track registered inventory and wholesale premiums are seeing a picture that the mainstream financial conversation is not yet fully processing. Does this mean silver is going to make a dramatic move tomorrow or next week? Nobody can tell you that with certainty. And anyone who claims otherwise is selling you something. What it does mean is that the conditions for a significant repricing event, the kind where physical reality asserts itself over paper positioning, are more present right now than they have been in years. And investors who understand that dynamic are better positioned to make thoughtful decisions than those who are simply watching the spot price and drawing their own conclusions. That is what this channel is built for. Not to generate excitement or to push a particular outcome, but to give you the analytical framework that lets you see the market more completely than the headline number allows. Now I want to hear directly from you. Go to the comments right now and tell me, have you personally experienced any difficulty buying physical silver recently? Have you noticed elevated premiums or wait times at your local dealer or online? Your real-world experience is genuinely valuable data, and I want this community to share it. The comments section on this channel consistently produces some of the sharpest market intelligence you will find anywhere online because this audience pays attention. Tell me what you are seeing on the ground. And if this breakdown gave you real value tonight, if it explained something you had been sensing but could not fully articulate, if it changed how you are thinking about your silver exposure, if it gave you specific things to watch going forward, please share this video right now. Send it to someone you know who holds silver or is thinking about it. Send it to anyone in your network who deserves to understand what is happening beneath the surface of this market. It takes 10 seconds to share, and it could genuinely change someone's financial decision-making. Subscribe if you have not already. Hit the like button. Stay informed. Because in a market where the paper price and the physical reality are telling different stories, the investor who understands both stories has a significant advantage over the one who only knows one of them.